Good morning. I'm Tamera Kovacs, Director at CETANE Associates. I want to welcome you to today's webinar, Advanced Acquisitions Update. One of the main reasons we created this webinar is we are constantly being asked what's going on in the acquisitions market. Today, you'll hear from our panel of experts who will discuss the changing state of the M&A landscape, effects of inflation, EBITDA multiple drivers, and the most important things a seller needs to consider. Today, we have from CETANE Associates, Steve Abbate, Managing Director, Jeff Brunner, Director, and Barrett Conway, Director. Before we get started, I wanted to mention a little housekeeping. As you have questions, please use the Q&A button at the bottom of your screen and we'll answer all of your questions at the end of the webinar. In my experience in over 20 years of valuing and selling companies, I've seen how valuations and the acquisitions are cyclical, usually tied to the economy. In the last couple of years, we've seen record costs for capital expenditures, supply chain issues, and staffing challenges, to name a few. So to kick this off, let's start off with a question everybody wants to know. Steve, I'm going to start with you. In the current market conditions, what are the current multiples that buyers are using to value businesses, and how are company values holding?
Thanks, Tamara. It's a great question. It is the type of question that we're constantly asked, whether it be at trade shows or people calling and just asking. We've surprisingly have seen values stay very, very strong as they've ever been, in my opinion, which is a little odd because the cost of propane tanks is up 50%. The cost of vehicles is up. Any kind of assets, real estate is up. So we kind of, we look at it. You have EBITDA, and if EBITDA hasn't changed, what has changed is EBITDA is earnings before interest, taxes, depreciation, amortization, but it's not free cash flow. Free cash flow is EBITDA minus capital expenditures, or also called distributable cash flow. And that has gone down for owners because owners have had to, they got to lay money out of their pocket for the capital expenditures. So you would think that that would push values down, but we haven't seen that. The reason we think that hasn't happened is there's a couple of things going on in the markets. One is people are still very aware of COVID. And we're an essential industry, and a lot of investors, particularly private equity groups who have various groups of funds, their other funds have not performed as well, so they're looking to put money into our industry because it's done very well during that period of time. We also, just the depreciation laws with bonus depreciation. Hard assets can immediately be depreciated this year, and then that's slowly going to go away. The bonus depreciation goes to 80% in 2023, and then 60, 40, and then 0. So we're still seeing some of that keeping prices up. And then as anybody who watches the markets, yesterday was a big day. When the inflation numbers came out, and there's talk of recession again, and we're in a recession-resistant industry, and so investors that do have cash, where do they put it? I mean, everything was down in the markets yesterday: stocks, bonds, gold, oil, everything was down. So what do they do with that money, knowing that there's likely a recession coming? And our industry is one of the few safe havens. So all of those things have been keeping value up, and I think that's the reason we're seeing record multiples of EBITDA and valuations. I don't know if anyone else has anything to add to that.
Just chiming in on the capital providers, I think they really saw everything in the last 2 years, and to your point, Steve, really bought into this is a essential industry, and it survives during the tough times, and that's really made them excited to continue to get into the space.
Yep.
So Barrett, you mentioned capital investors. So we know that they're looking to put their money into essential industries. What are the key value drivers that buyers are focused on?
Yep. So speaking to capital providers specifically, I think one of the first things that we got to kind of check off the box with them is that size of the company and the EBITDA size. A lot of them have a minimum threshold of 2 million in EBITDA. And that can even, we've heard it jumping up to even $5 million of EBITDA. But then buyers in general, there's a lot of value drivers that will drive your company up when you have these in good areas. So some of those are margin. How's your margin within your area? And then in general, do you have a strong margin, or are you on the lower side as a discounter? For propane businesses, a big one is tank control. So how many of your propane tanks do you actually own? A higher percentage will drive up that value because you have more company assets. I think another one that we touch on quite a bit is just quality of equipment. Do you have a really nice looking fleet? Do you have a nice looking facility? We saw one a few days ago. We saw a video of the facility, and it was just in pristine order. Everything was in perfect condition. And I think that speaks to the company as a whole. How you operate your business in general probably is a reflection of how your facility and fleet look. The future growth opportunities, what is kind of the market looking like? Are there detractors or not? And then I think one final one is customer demographics and then customer concentration. So what does your customer makeup look like? Is it kind of that higher end customer demographic? And then is your delivery area tight, or is it spread out? A lot of those are value drivers that drive business up and down. Any others, Steve or Jeff, that I missed on there?
Yeah, Barrett, I just elaborate a little bit on the real estate. You mentioned real estate as part of the equipment and how that adds to value. I certainly agree, and not every transaction, as we know, has real estate involved. But when it is involved, obviously it can slow down the due diligence process and ultimately delay getting to the finish line or the closing. And so, not just aesthetically, but I think the real estate, it's important to know what studies, if you've had appraisals done, or phase ones, phase twos, fire safety analysis, all those things. Know when you had them done, if you had them done, and be able to put your finger on those documents quickly. Don't worry about how old or new they might be. The point is that it just adds to the value of the real estate. It shows well, and it can ultimately just add to the overall value.
I'll throw in, I mean, one of the first questions buyers ask us is, are they fully staffed? And that has become a value driver where it wasn't 5 years ago. And on the opposite side, probably a little more so on heating oil, but will call versus automatic delivery. It used to be, will call was very low value to it, but kind of with the new home buyer being that millennial home buyer, very computer savvy, the will call is not a detraction. The percentage of automatic versus will call has actually gone kind of down on the list for value drivers a little bit, which was something that we've seen over the last few years.
I'd like to add a little comment to yours, Steve, when you mentioned staff. Are they properly staffed is one thing. I think a couple other things that buyers look at is, what's the age of the staff? Are a lot of them getting close to retirement age? And then the other thing is, if that owner is not going to stay on with the new buyer, do they have management in place that can continue to run the operation? I think that's a really key point that a lot of buyers are looking at, especially if, one, they're capital investors. They definitely need that management team. But even if it's somebody who's stepping into a new marketplace and they're not, don't have any overlap, they're also going to need that team in place as well.
Yep.
Absolutely.
Great. So Jeff, I'm going to address this one to you to start off with. So buyers are not only facing an increase in capital expenditures, but also in operating expenditures, specifically fuel costs, employee salaries, particularly driver and service technician wages. What types of changes in their operations have sellers made to maintain value and free cash flow? And secondly, how has this impacted the buyer valuations?
Okay. Again, a good question. Yeah, I think we've we all know that when you have increased costs, and again, fuel costs, as we know, I mean, just go down through your P&L line by line, and all the lines that are impacted by increased fuel costs. It's just significant, and it's easy to go to the margin, right? We've always just said, look, we just have to increase your price. You have to maintain your cash flow. But more recently, we've seen sellers, we've seen owners do a variety of things and get more creative. Do things like institute minimum usage fees where they don't currently exist, tank rental where maybe it doesn't currently exist, or even if it does, it's time to review that. And are you charging what you should be charging in today's climate? What's your competition to maybe when you instituted that years ago, you didn't have as many competitors doing it. And so it's a good time to review those things. Seen owners and sellers invest more in delivery routing and all the efficiencies that brings to productivity and ultimately reduce costs and driver wages and truck expenses and so on. So the list goes on, and it's great to see sellers and owners getting creative and doing a good job maintaining their cash flow in these increased cost times without going to just the margin. It's been good to see.
I'll throw in just 2 days ago, Barrett and I were visiting a client, and he shared with us that he shopped his insurance expense, and he went from $250,000 to like $105,000. So that's almost $150,000 savings, and now we're getting ready to put his business on the market. That'll be over $1 million on the purchase price, that one line item, because if you multiply it by, he's mostly propane, he's got some oil, but just pick a number, 8. We don't know what the multiple is yet, but it's in that range probably. That's $1 million on the purchase price just from shopping your insurance. So there's something that just to understand. Now he did go with a $25,000 deductible, so he upped his deductible. So he might have a little bit more expense in there at the end of the year, but it's darn close to $1 million.
Yeah. I think one more thing to touch on that you did quickly, Jeff, is just technology in general. I'm thinking of one example where they updated everything monthly, and with this crazy market that we're in right now, with prices changing 20% in one day, they couldn't react and adapt quickly because they didn't really know where they're at. I think there's a lot of different technologies that help you really see the picture of where you're at, either end of the day, end of the week, end of the month, and you can really assess where you're at and what you need to kind of focus on during these trying times.
Right.
Yeah, I was going to say, another piece of technology that we've been seeing a lot of is tank monitors, and being able to, if you don't want to put them on all your tanks, put them on the ones that are, erratic, that you don't have, can't really track them, whether it's through degree days or, they don't have, they have sporadic usage or very large user accounts. Those are some great areas to put those on. But we're seeing a lot of companies put them on the majority of their tanks in the field, and they said that they're seeing phenomenal improvements in their, efficiencies for delivery.
Right. Yeah, and that's depreciable item typically. So right away it's not an expense item, so it doesn't affect your EBITDA, and it gives you operating efficiencies, which increases your earnings. So again, immediately it adds to the value of the business.
Right. Yeah. I think it's just, like Jeff said in the beginning, you can start with the margin, but then there's so many other things that you can look at to have savings that impact the bottom line, and that it's a combination.
Yeah. One other thing that I've seen out recently is there's some different delivery programs, not just routing software, but actually software for pulling tickets in areas that have heating degree days, where you don't use your typical K factor and you don't use your typical degree day, but you use these algorithms to determine when's the best time to deliver, so you don't have to, so you're not delivering every one of your customers in that 3-week period in January, as an example. Maybe you do a short delivery in December, because then you don't have to deliver again to February. and it kind of smooths out the delivery curve. Those are very interesting things that we've seen that have helped people.
Great. So I'm going to address this one to the whole group. So I'll let you guys, chime in. With the increase in the cost of hard assets such as tanks, has that driven values for companies up?
I guess I can jump in on that. Yeah, that's another one recently we've been getting. My tanks are up $1 million, therefore the value of my business must be up $1 million. Not really, because you're investing into a business. You're looking at the return. It's just like investing, in a stock or in the bank or whatever. What is your return on investment? And if anything, it should do the opposite as far as because your future capital. We talked about that a little bit, but really you've got the same return on investment. So although the hard asset value has gone up, doesn't necessarily mean the company value has gone up. Now, for all those other reasons we talked about, and in addition, there's leverageable assets. You can go to the bank and borrow at low rates, fairly low going up, but fairly low rates. So that is an advantage of having a higher value in your tanks, a higher value in your trucks. But it doesn't really, necessarily raise the value of the business. You guys, any other comments on that?
Yeah, I mean, you touched on a lot of it quickly earlier, but I think a big thing that's kind of helping the other side and the buyers is those bonus depreciation laws that are currently in place. Like you said, right now they can appreciate 100% of those hard assets, and then it'll stair step down over the next 5 years. I think that's been helping stuff not impact as much, like you said, that value. So it doesn't feel like your business has gone up $1 million, but you're not getting dinged as much on the cash flow as you might think.
Okay. Jeff, what are the most important things the seller considers when choosing the right buyer?
First thing that comes to mind is culture. I think listening to, in our process, as many of you know, we have buyer seller meetings, and it is the probably the most critical point in the entire transaction process in terms of buyer selection. And I think sellers, it always comes down to culture. Do you have the same core values that I do? It's about the employees, it's about the customers, it's about the community involvement, and it all, with the culture. I'll use the word again, the word culture being the nucleus of that whole thing. So it's all those things, and we often see that certainly rules. I mean, purchase price is obviously a critical item, a very, very, very important item. This is the exit strategy for most sellers. But at the end of the day, most times, 9 out of 10 times, we see sellers putting that whole culture theme ahead of the actual purchase price.
I'll just jump in. As Jeff said, we have a certain process that we use, and other people do it differently. But we like to get, we like to solicit offers, and first of all, kind of narrow it down from financially, are they in the ballpark? And then when you meet with them and our client sits across the table, and we kind of step back at that point. It's to see the relationship. We jokingly call this phase speed dating, because this is where the buyer and the seller get to know each other. And we find out that if it's a match, the price just doesn't, the value of the company, or the purchase price becomes less of an issue. Either the buyer is going to increase a little bit because they know it's the right fit, or the seller's going to say, I want to do it with those guys because my employees will be happiest with them, and they're the ones who got me where I am, or I got to still live in this town. I want to make sure it's going to be a company that's going to take care of my customers, not going to jack the margins up $1 a gallon from where they are now. You know, and then they're embarrassed to go to a restaurant or to the supermarket. So, you know, and we coach them to that too, you know, get the right buyer. That's the best way to go about it, in our opinion.
Great.
Great. Anything else anyone wants to add to that question? All right. Well, we've got a few questions that I'd like to go ahead and kind of start on the Q&A section so that we make sure that we get through everyone's questions here. And like I said, as you know, we're going through these. If you have questions, please put them in the Q&A and we'll get to them. So the first question that we have is, can you give us a range of EBITDA multiples that you are seeing in the space?
Yeah, I'll grab that. You know, there's a couple of spaces here. Some of it's regional. You know, we're a national company, so we do stuff all over the U.S. You know, but there's a lot, and we started in New England, so we get a lot in New England. And then New England's a dual fuel market. There's a lot of heating oil and a lot of propane. So I mean, some of the value drivers, you know, size of the business makes a big difference in the EBITDA multiple. And then the other stuff we talked about makes a big difference. But, you know, we do get this question a lot. What are companies, what's the multiple companies are selling for is another way of asking that. So on the heating oil side, we don't deal at all with distressed assets. So we're talking, you know, good companies, decent companies. On the heating oil side, you know, we've seen lows in the 3.5 times range, and highs in the 5 times range for a solid, good company. If they have some propane in there, we have a couple of them actually right now that have about, you know, 80 to 85% heating oil, and we're seeing almost 6 times. But they're really good companies with nice assets, like Jeff pointed out. On the pure propane side, higher than that. We larger company, we did a transaction not too long ago where we saw over 9 times. But that's, you know, again, a much larger company, good competitive process, you know, good management team in place. Like, it hit on all the value drivers. So you see larger numbers there. Smaller propane companies, 7 to 8 times pure propane. Propane
Yeah,
is still highly sought after.
Right. I would say that also is dependent on your geography. There are certain parts of the country that won't get that high a multiple. You know, they may be in the, you know, for good companies in the, you know, 5 to 6 range. It just depends on, a lot of it is where you're located and what your customer mix is. I mean, that's a big piece for propane. You know, if we're talking primarily, the numbers Steve was talking about is if you're primarily residential, you know, getting really good margins in a really good marketplace. If you're, you know, much heavier in commercial and ag, those numbers are going to go down. So I think that's something that's really important to mention.
Yeah, if you have bids, if you have non-recurring gallons that, you know, come and go, like you said, the ag can vary greatly. Then you see the multiple swings, or you'll see an earnout. Well, they'll give you so much for the business, and if you hit goals, you get a bonus. We've seen that occasionally. So
Right.
And I just want to touch on quick, Steve's talking about the adjusted EBITDA is what we usually use. So the seller's EBITDA is kind of the straight line. Here's your net income, take out the EBITDA items. The adjusted EBITDA is what normalizes it. And then the buyer's EBITDA can potentially be higher. So these multiples that we're talking about are really reflected in that adjusted EBITDA number, and not necessarily either the seller or buyer's number. Just wanted to add that quick.
good point. Thanks, Barrett.
Yeah. Okay, so let's move on to the next question we have. Have you seen companies charge delivery fees for oil and propane? Warm Thoughts has been marketing this policy.
Yep, I'll jump in again. I was doing a business valuation for a company, and I think I've done 4 of them in the last 10 years for the same company. And all of a sudden I saw this miscellaneous income kind of jump off the chart at me. And so I, had to ask the owner, what's going on with this? Where did this extra $100,000 come from? And they said, we implemented a delivery fee program. And by the way, it happened to be a heating oil company, not a propane company. We see it much more often in propane. And so I asked them about it, and they actually happened to use Warm Thoughts, and they said it's amazing. It's 5,000. We have 5,000 customers, and of those, when we implemented this, and they did it a certain way. They sent out the right letters. They trained their people, how to do this, and they had like 3 or 4 complaints, and they had 1 customer loss and $100,000 more on the bottom line. Multiply that times your EBITDA multiple, and that's what it did to the value of the business. And in my valuation, we had to increase the value of that company. We've seen many companies do it. Tell a personal story. I don't want to take up too much time, but first time I had propane, it was for cooking gas. I know all you propane people love customers like this who just use it for cooking, my 26 gallons a year or whatever it was. But when I calculated it out, because I'm always doing the math, they would charge me $75. This goes back 15 years. They would charge me $75 a year for the tank. They charged me $19 to pull in my driveway. And so I thought that was interesting, and not to complain, but just to learn more. I called up the company and asked them about it. And they explained, well, one's a delivery fee to get the propane into our yard, and the other is a delivery fee to get the propane to your location. So when I figured out what they were making on this, yeah, it wasn't a great customer, but maybe I would add additional appliances and things like that. They weren't losing any money on me. And it was due to delivery fees and the value of your business, particularly now with the cost of tanks. How do you handle a small user? You can charge them, $6 a gallon margin, or you can implement a delivery fee or some other, whatever you want to call it, hazmat fee, whatever your state allows. Some states don't allow it, so check with your local trade associations to see if you can do it in your state. So. Anybody else?
Yeah, just a huge value driver in many industries, not just this industry, is recurring revenue. And I think once you see that over 3-4 years, that's going to be a huge value add. Capital providers and strategic buyers like to see recurring revenue on stuff that just comes in as part of normal operations. And that's a huge bonus, having that added in.
Absolutely.
Right.
Yeah, I guess Tamera, before we leave this topic, I'd like to add to Steve. Steve mentioned the education and training for the employees when you implement something like this, and we can't stress it enough, really. And not to state the obvious, but I've seen this done poorly. I've seen it done very, very well. And whether or not you use a marketing company, you definitely have to explain to your employees why you're doing this, make them part of this decision process, the implementation process, have a tracking system set up for how many calls they get, how many negative reactions they get, how many customers threaten to quit, or whatever the case might be. But definitely have a very disciplined, methodical approach to implementing something like this. It's not an easy decision. It's a very sensitive topic, but to do it well, I've never heard a bad result, or never heard anybody turn back away from it after they've implemented it well.
Great, thank you. So we have another question. With backwardization in the market, is fixed storage less valuable now than in previous years?
Yeah, that's something I remember one of the majors told me one time. They made more money on the carry in the market than they did in actually selling fuel to their customers. But that's something that changes back and forth. And what we're talking about here is, if you can buy fuel, whether it's heating oil or propane, but it tends to be more on the heating oil side. If you can buy fuel and put it in the tank at $3 a gallon, and then it's trading for 330 in January, then you sell the future out and you make that difference, you make the spread. If you have a heating oil company and you're going to use that fuel, it's, you know, it's not speculation, it's hedging. And it's a very important tool if you have storage, to leverage your storage to make money on your storage. Lately, we haven't seen a carry in the market, or the market being in contango, as they say. But when it happens, it's great to take advantage of. As far as the value of the business as a result, not really. It's such a rare occurrence. It's similar, like you know, when it's a very wet season for crop drying, and you're using a lot of fuel. You know, it's a little different because you're actually delivering the fuel and making money on it. This is strictly a paper hedging play. So most people don't factor that into the value of the business, because it only hits when the markets are right. So I don't know if you guys, anybody else comments on that. I deal a lot with that, with that stuff. I like, I'm strange. I actually like doing those analysis. It's challenging.
Right. So we had another question that was very similar to the first question. I'm going to go ahead and ask it anyway, even though I think we answered it, just to see if anybody has any other takes that they want to mention on this. Is there a big difference between EBITDA multiplier for oil and propane?
Yes, and a lot of it is the tanks. You look at the value of the tanks, and they're depending on tank control percentages, 1.5, 1.75 multiple, just the value of the tanks. Because when we talk multiple, we're talking all in. Real estate, if you have it. If you don't have real estate, the multiple is typically lower. Propane tanks at customer locations, that's in there. So if you have a lot of them, then that's part of the increase in the multiple. You know, we talked about vehicles and other things. Those are the two main differences. Propane bulk storage is highly desirable, and you know, more difficult to get permitted because of the nature of propane. So if you have that in place, that definitely drives the multiple a little bit more. That's the biggest difference. And then there's your regular supply and demand. It's hard to find a pure propane company in the Northeast. You find them in the Midwest, Southeast, the rest of the country. So propane, more people want to buy propane companies than heating oil companies. So the supply and demand drives that up, but that's not the real driver. It's hard assets is the real driver. The real driver in the difference, in my opinion. And also you know, you look at the future, you know, now with renewable propane, you know, propane and oil are both attrition fuels in general. People use less every year due to conservation. Happens to be New England is actually growing their propane, and they're shrinking on their oil because more people are going to it, because it's a more flexible fuel, in that you can use it for, you know, clothes drying and ornamental heating, and you can use it for cooking and generators, where heating oil is heat and hot water. So a homeowner, you know, that's looking to change out their unit, a lot of times is putting in propane, you know, so that's why we see, the other reason we see a little more interest in that and a little higher multiple.
And I'd just say the margin's typically higher than oil. So I think that drives it up as well, as you're going to make more money quicker, so you can extend that cash flow out multiple years and buy into further years. Sometimes the easy math I like to think of as a 5 times EBITDA. That's going to take me 5 years to pay it off. In a perfect world, everything stays the same. So I think that higher margin gives people comfort that it's going to last longer, and that's why they pay more.
Right.
And if they're using it for heat, propane's 98,000 BTUs per gallon, and oil's 138, 139,000 BTUs per gallon. So you're burning more propane at a higher margin. I mean, how can you not like that as a fuel dealer, you know?
All right. The next question really ties into what you guys were just talking about. On the EBITDA multiple, what value is on top of that? Real estate, bulk plants, trucks? Sounds like the company-owned tanks would not be additional.
You guys want me to start off again? The other things you get in addition to that, and it depends on the offer, is working capital. Usually you'll get either paid for your receivables, discounted but paid at closing, or they'll collect your receivables and remit it to you. You know, so you'll get the receivables. Inventory sometimes is included, like parts inventory. Sometimes it's not. Propane tanks in the yard, most of the time that's part of that purchase price. It's not in addition. And then there's the little things, prepaid expenses. You know, you got $1,500 of postage on your postage meter. That's in addition. You usually have to, there's adjustments. If you have service contracts and you've collected money from customers, so it's paid in advance, that then goes over to the buyer. Sometimes you have tank rental agreements that are paid in arrears. They're paid at the end of the year after they've rented the tank. So those go back to the seller. So there's all sorts of working capital type adjustments, service contract adjustments, those type things that we see. You guys add anything to that?
I would like to add something that we haven't said yet is when we're talking about these transactions and these multiples, we're talking about an asset transaction, not a stock transaction. And I think that's something really, really important to mention. And the reason I thought about it is when Steve was talking about the currents and what they paid for and those kinds of things. You know, buyers want these assets free and clear of any encumbrances and liabilities. They also, you know, any debt that you have, that's going to come out of that purchase price. So they're not going to assume that debt whenever they buy your company. There are occasionally stock transactions, but they're very, very rare in the propane and refined fuels or fuel oil space.
Yeah, and Tamara, we should probably also mention allocation of asset. This is important. It's not all about the purchase price. Sometimes it's about the allocation of asset. We've seen companies that come in and they want to take 20% of the purchase price and put it towards non-compete. Well, that goes to an owner as ordinary income as opposed to capital gains. And there's 17% difference in tax on that. So the allocation is important. What's very unusual right now, and it's probably, you know, might be a short-term thing, is propane tanks have gone up so much in value that when you look at the original cost basis, if your tanks cost you $1 million and now they're worth $2 million, and the buyer says, normally we used to negotiate and say, well, you know, he paid $1 million for them, let's do them at $500,000 because they're depreciated. You can't do that now. There's no way that they're worth less than that original $1 million. So for the seller, anything over $1 million is capital gains. It doesn't matter whether it's customer list or whether it's propane tank for the seller once it gets over their original cost basis. For the buyer, there's a huge difference. 15-year amortization versus instant first-year depreciation. We've actually been able to negotiate higher purchase prices by putting more money into the tank value. So there's the whole allocation of asset is something that is a negotiation into itself that goes beyond the purchase price.
Yeah, well, we're still on. Oh,
was that the question? I forget.
Well, yeah, they were talking about, you know, what other things happened, you know, on the EBITDA multiple, what value is on top of that? Real estate, bulk plants, trucks. Sounds like a company-owned propane tanks would not be additional. So we're kind of talking about those additional items that they would get. Typically, when a a company buys, the real estate may or may not go. You know, if you own that real estate and you lease it to yourself and you want to continue leasing it, that's an option that you have. You don't have to sell the real estate. That's an option. Bulk plants, typically buyers on the propane side want to own those tanks. I'll let Steve talk about bulk plants on the refined fuel or on the fuel oil side of things. Trucks are included in it because it's something that they need to continue to run the operation that they're acquiring. Steve, you want to talk about bulk plants on the fuel oil side?
Sure. And let me, I realize everyone's time's valuable. So, we'll stay and answer questions till whenever. But, technically it was a 30-minute webinar.
Right.
So I just want to mention that. So anybody who wants to hang in there, hang in there. Otherwise, thank you for joining us. Yeah, a propane bulk plant, you can get a crane and move that tank, and there's a readily available market for it. So there's a certain value there. And we've done that. We've sold several companies that they said, well, we want the tanks, but we don't want the land. And they come and they take the tank. Not the same with distillates. Distillates tend to be permanent fixtures. We usually advise clients, if you're going to sell this property that has a bulk plant on it, try to sell it when you're selling that distillate business, because they're very hard to sell unless there's some strange reason that the land. I knew of a company in the Washington D.C. area that the land was worth $10 million, and as a bulk plant it was worth about $100,000. So that's different than you pay to have the tanks taken down and remediate and then sell the land. But in general, propane tanks are just easy to handle compared to distillate. Yeah.
So there's another question that I think we're touching on it, but I want to make sure that we really address as a direct question tied around bulk plants. What is the bulk plant value of a single propane tank bulk plant? Do you commonly see leasing of these facilities from the seller?
What's interesting is we see a lot of land leases. The owners of the companies, they own the tank, and then they just lease the land from someone. Sometimes they buy the property. What are those values? I mean, the tanks themselves, you can go online. There's some people that's all they do for a living is trade 30,000-gallon propane tanks, all different, the stubbies and the different years and stuff. So there's a market for that. It depends on, is it a tough area to get a tank in? Can someone else, replacement value to put a 30,000-gallon tank on a piece of property with everything that's there. I'm not a tank installer, but $350,000 to $500,000, I think, to build a new one, if you own the land already. What's that worth to a buyer? Maybe that number, if it's highly desirable. The piece that you don't have is the permits and the permitting process. How difficult is it? Will that township let anybody put in a propane tank on any piece of land? Then it's a different value than this thing's grandfathered in. Then you're gonna get a premium for the the fact that it's already there. I think that's the answer. I don't know if you guys have.
Yeah, it's hard. Let me jump in there. It's hard to, I think it's hard to assign a value to the tank. Let me just say that 9 out of 10 times we see buyers want to own the tank. Whether they're going to own the property that it sits on or not is a different story. They'll usually accommodate the seller's desire there. Does the seller want to continue to own the property and lease the property? But 9 out of 10 times the buyer wants to own the tank. And the ownership of that tank will be baked into, they'll circle back to the whole offer process and the assets that are included. That'll be baked into the offer. That'll be baked into the multiple. And the only place that you might see a value assigned to that propane storage tank would be in the purchase price allocation that Steve mentioned earlier, where the seller, the buyer will will propose X number of dollars to vehicles, X number of dollars to tanks and bulk storage, X number of dollars to land, X number of dollars to customer list, and so on. But generally speaking, that'll be embedded in the overall offer multiple.
And the final piece of that question, do we see leasing or not? It really depends on what the seller wants to do. And we've seen it always. So when we are putting a company on the market, we'll talk with the seller and say, what do you want to do? And we'll put our financial model together with what they'd like to do. And we see offers come in every way, though. We will put that in our SIM document that they'll entertain offers to lease or sell. And then we'll end up seeing them all different ways. So there's not a hard and fast, yes, they lease and no, they only sell. It definitely varies case by case.
Right. So, so we had a question that was circling back based on one of the answers that we gave. And it says, you said a 9 multiple for larger propane companies and a 7 or 8 for smaller. How do you define larger versus smaller? How many gallons? So I want to start off and address one issue here, and then I'm going to let you guys speak as well. First of all, it's you have to be very careful when you're talking about gallons. Gallons is one piece of it. You know, it's really what the EBITDA is, what the trends are doing, those kinds of things. You don't want to get locked into gallons because it's also tied to what type of gallons do you do. Like I said earlier, are the residential, commercial, ag, what's those mixes of gallons? And I think that's really important, not to get hung up on gallons, but I understand where your question's coming from in that larger companies versus smaller companies. I've seen small companies, 1 to 2 million gallons go for very large multiples in that 8, 9 range. But again, it was a strategic buyer who had a reason for wanting to make that acquisition. So, the majority of the offers came in probably at that 6 range. But then you have that 1 or 2 strategic buyer who's looking at that acquisition for a particular reason, who's willing to pay more and pay a higher multiple. So I think you have to, when we're talking generalizations, what the masses are, we can see them going higher, but the majority of the offers we get are lower and probably in that more normal range of what we would think of that, 6, 6.5, 7. But it may also be, like I said, it's that strategic buyer who's willing to pay more for that business to get it pushed up there to that higher multiple. So guys, I'll let you guys add into that.
You just answered it.
Okay. Just want to make sure that, somebody else didn't have another point they wanted to make on that.
Yeah, we had that small one that was, go ahead, Jeff.
I think it's a great point. Because one of the things we didn't touch on that can be a value driver is what you just said, Tamera, that every now and then there's a buyer that wants to be in that region and currently isn't there, and they're going to pay up for it. So that's why we always talk about a range of multiples, right? And it's not just all the little things that we talked about that are embedded in the business, but it's on the buyer side. It's the interest level, like you said, the interest level in the buyer. Do they want to get into a brand new market? They're willing to pay up to do that, and those things can benefit a seller sometimes.
Mm-hmm.
Right.
I think a lot of it feeds back to the competitive process. If you're a seller and you're just dealing with one buyer because you heard that they buy a lot, or a friend of yours in the industry, they did a deal with them and they did a good job. That's great, and they probably are a good buyer. But when you get into a competitive process, people are going to pay up, to your point, if they want to be in that market. We actually had that small one that went for 9 times. Which we were surprised. We always try to manage our clients' expectations, and we love it when it comes in higher. Our client makes out, we make out. We work on a percentage, so we want the cost, we want the selling price to be higher. So it's a hard question to answer. What are the multiples going for? What size was that big company? What size was the small company? It really depends. I think, the numbers I gave you are ballpark, but you could be in a bad area with a lot of conversions to heat pumps, a lot of conversions to natural gas. You could just be in an undesirable area. And that could hurt your multiple versus, or there's nobody in that market who's a decent competitor that wants to even look at your business. We rarely have that, but on occasion in certain markets, particularly on the distillate side, it's hard to find a good buyer, and the offers that we get are not what our clients want to take. But in general, if you cast a wide enough net with the right buyers, who that's why we only deal in this industry. So there's some buyers out there you don't want to deal with, so you use an intermediary, like whether it's us or there's others out there. This is what we do every day. This is what we work with every day. That's why we advise clients the way we advise them. So if you're not using someone who that's their profession, you can expect to get a slightly lower multiple on your business as well. That's my advertising pitch for the webinar. So
yeah. So we've got a couple of other questions. One, I think we can answer pretty quickly. It was talking about how about the cash in your checking account? And that's going to tie in right into this next question that I'm going to ask as well. And that's, how does a stock transaction differ from an asset purchase? So let's start with the cash in your checking account first, and then let's talk about how a stock transaction differs from an asset purchase.
You keep your cash and you pay your bills. So if you have invoices and accounts payable, you have to pay them. And then if you have cash in the bank, you keep it. That's the general rule. Stock transactions, which are very rare, occasionally you see them on larger companies. We didn't even talk about the whole C Corp situation. If you're a C Corp and you sell your business, you're subject to double taxation. The corporation gets taxed, then the business gets taxed. There's some strategies around reducing that tax burden, particularly the use of personal goodwill. Personal goodwill, not just for federal taxes, but in certain states, Pennsylvania, New Hampshire, this separate entity taxes when you sell the assets of your business or the stock of your business. And so we use those strategies to reduce tax liability in certain states. But if you sell stock, the other thing is there's your cost basis. You've already depreciated all your trucks. You've already depreciated all your propane tanks. So if the new owner's coming in, they don't have that tax advantage. So it devalues the company. We talked a lot about why values in this industry are holding up. And a big part of that is because of cash flow, because you buy a company and you're not paying tax the next year, and you're throwing that money right back into the business, and then you can go do more acquisitions with it. But with the stock sale, you don't have that unless you write up the assets. I think it's called a 338 election. And that is what the seller will request of a buyer of stock. Is the buyer will request of the seller is that they write up those assets so they can depreciate them. So you write up the assets, then the seller has to pay capital recapture, ordinary income on that write up of those assets. So that just blows your tax advantage. So there's not that much of an advantage to buying stock, and then you get into all the liabilities, and you can protect yourself as good as you can, but sales tax, they could come back and audit you, and then as the buyer, you're on the hook for it. There can be employee issues that you're on the hook for. So it's just very rare to see in any industry, but particularly ours, particularly if you have refined fuels with environmental. But stock deals just aren't done, if it's under $40–50 million. Very rare.
Yeah, and there's a couple of reasons why. One is, you take on the liability from the day the corporation was formed. For a fuel oil or propane company, that's something that most buyers aren't willing to do. The second thing is, you can't restart the depreciation because you're buying an ongoing entity. You're not buying the assets of the business. So you can't automatically, depreciate those. So a couple of reasons why it's not very common in this industry.
Yeah, see, with C Corps, we have, you see a lot of the client who's a C Corp, their accountant is like, just sell the stock, just sell the stock. It's not that easy. That's why these other strategies like personal goodwill, which is taxed at capital gains rates, putting more money into a non-compete, putting more money into a consulting agreement that are taxed one time at ordinary income, again, higher than if you were an S Corp. It takes 5 years to convert from a C Corp to an S Corp. And we've worked with clients for 5 years. We advise them, hey, you're young enough. Do you want to hang in there? Where some clients have come to us and they did it 2 years ago. And we usually advise them, hang in there. If there's a pressing family reason or something that you want to do it, then we'll structure it to minimize your taxes, but it's a 5-year wait.
I think it's worth talking about the valuation done at that time of conversion too. If you do a business valuation on your C Corp at the time of conversion to an S Corp, and let's say it was $5 million, and you decide you want to sell in 3 years and your company's now worth $7 million, that $2 million gain will actually be taxed as S Corp at S Corp status. And then the remaining would be C Corp if you don't make it to that 5-year time frame.
Good point.
Great point. So the last question that we have here is talking again about deal structure in a way. It says, also, can you talk about retained gallons deals and how they are structured? Are they common in propane? I know they are with oil.
We rarely do a retained gallon deal anymore. And the ones that we do, we always build a floor into it. So you're never going to get less than X dollars. The few that we've done in the last couple of years, and they are typically on the oil side. I don't remember ever doing one on propane. The floor or the amount, the cash at closing was higher than the next highest offer we had. So it was a no-brainer. We don't like retained gallon transactions. We advise against them. Because the buyer, typically their bank has a blanket lien on all their assets. So if you do a retained gallon transaction, you don't have any security on getting paid. Yeah, they owe you the money, but if something negative happens with that buyer, you're in that second position or further down. You're not going to get a first position. You're not going to get a UCC1 lien on that company's assets. The bank already has it. We've done them. Reluctantly. Usually it's not an A company. If it's an A company, it's a cash deal. It's that B minus company that sometimes there's things you can do to protect yourself. The number one thing is everyone's, if it's retained gallons, the buyer comes in, they raise the margin, they lose this business, we get paid on gallons, so we take it on the chin as a seller. You can build minimums in there. You can do a deal and limit what the buyer can raise the margins by. We've done that also. You got to make sure it's not just the customer on the customer list, but it's the customer and the customer address, because 5 to 7% of your clients move out every year. You want to make sure you retain that address. And if you're smart enough, you want to retain the customer too, if they move into another location. So there's things you can do to limit your exposure on a retained gallon transaction, but in general, we just frown on that. And there's enough buyers out there that usually you can find one that'll pay you cash, or at least some, a large percentage of cash at the closing.
Yep.
I had another question that just came in. How often is the seller taking back paper?
So sometimes the seller, our client, wants to take back paper. there's actually certain tax advantages to that. I learned something from one of our clients. We learned from everybody who wanted to take paper. I'm like, why would you want to take paper? And he said, well, I'm going to set up a separate LLC as a consulting company, and I can if I take the paper in under my company, then I can do what's called a cash balances retirement account and put away almost $300,000 a year tax free. You know, that was a new one that I had heard about. It's usually for tax purposes to spread it out. And then sometimes it's, you know, we negotiated, this is when interest rates, when you were getting 0.25% in the bank. So, you know, 4 or 5 years ago, we did an 8% on $1 million. It was a small percentage of the total purchase price, but the owner's like, you know, that's 8%. Where am I going to get 8% from? You know, it was subordinate to the bank, but they like the interest rate, so they took it. So there's certain advantages. They were also a little upset when the buyer refinanced and paid off the note early, but that was part of the deal. You know, at least he got his cash.
And that's usually just a small percentage of the total transaction. We're not seeing that for 100% normally.
Right.
Correct.
Good point. Good point. Well, I think that's the answers or all the questions that we have. I think we've gotten through everyone's questions, but the webinar will be available to everyone to review. And if you have any questions or want to discuss something further, please reach out to us. Our contact information is on our website, cetane.net. And thank you all for attending.
Thank you.
Thank you.
Bye.